If you tried renting a property in London over the last few years, you probably remember how intense the market became. Properties would go online in the morning, and by the afternoon, agents already had 10 viewings booked. Tenants were offering above asking rent. Some tenants were offering several months in advance in order to secure the property. And in certain areas, even finding a decent apartment became extremely difficult. But now, in 2026, something interesting is happening. The market is still expensive, very expensive. But for the first time in years, we are starting to see signs of stabilization. Rental growth is slowing down. Tenants are becoming much more price sensitive. And at the same time, new regulation, you can check my specific video on this topic, the rental reform here, or find the link in the description, is beginning to reshape how landlords think about the sector. Zoopla's latest rental market report also shows that rental growth across the UK has slowed to 1.9%, with enquiries per rental property falling to 4.8, the lowest level in 6 years. So the wider market is clearly moving away from the extreme conditions we saw after COVID. So in this video, I want to break down what's happening in London's rental market in 2026, using actual market data, investor trends, and also what we are seeing directly through our property management activity. And trust me, some of the numbers are very, very interesting. I am Marco Fasanella, I'm a member of the Royal Institution of Chartered Surveyors, and I work in real estate as an advisor and asset manager, with over 15 years of experience across the UK and Italian markets. I am co-founder of Habitat Investments, our development company, and Habitat Living, our operations and property management branch. On this channel, we focus on explaining how real estate works in practice, covering investment, development, and operations, always in a clear and practical way. Now, the first thing to understand is this. The London rental market is no longer in the same phase we saw after COVID. Back in 2022 and 2023, the market was almost chaotic. Demand massively outpaced supply, rents exploded, and landlords had enormous pricing power. Today, the situation is slightly different. According to the latest Landlords Prime London Market Update, Spring 2026, rental growth across Prime London returned in the first quarter of 2026. After a few weaker quarters, we've achieved rents increasing by 2% annually across Prime London and 2.6% in Prime Central London. Now, on paper, 2% growth may not sound dramatic, but context also matters. Because after several years of extreme rental inflation, the market is finally beginning to normalize. And here is the interesting part for investors. At the same time rents remain high, yields are actually improving. Landlords data shows average yields across Prime London increased to 4.96%, compared with around 3.5% during 2013-2020 period. That's a pretty significant shift, especially because capital values, so actual property prices, remain under pressure while rental income is stabilizing. And this is why many investors are starting to look at London very differently again. Not anymore as a short-term appreciation play, but increasingly as an income and asset management market. Now, before people start saying the market is crashing, it's very important to keep perspective, because London still has a major supply problem. Even though listings activity has improved, Landlords notes that available rental stock remains around 50% below pre-pandemic levels. Think about that for a second. Even after all the new developments happening across London and all the institutional investment, supply is still dramatically below historical norms. And this explains why rents remain so high. Rightmove's Q1 2026 rental price tracker also shows this very clearly. Average advertised rents in London rose by 0.7% in the quarter to 2,736 per month, while the average rental property was still receiving 8 enquiries, down from the 2022 peak, but still above the pre-pandemic average. So yes, demand is cooling, but London is not suddenly cheap. At entry level, a room in a shared property still averages close to £1,000 per month, and in prime central London, areas like Kensington, Chelsea, Knightsbridge or Mayfair, even a standard one-bedroom apartment can easily exceed £3,000 per month. Then you move into the luxury market, and suddenly you're looking at penthouses overlooking the Thames, concierge buildings, spa facilities, gyms, private lounges, and rents for a two-bedroom flat of £7,000 up to £10,000 or even more every single month. And what's interesting is that many of these tenants are not unable to buy, quite the opposite actually. A lot of them are international executives, entrepreneurs, diplomats or wealthy families who simply choose flexibility over ownership. On this specific topic, whether it makes more financial sense to buy or to rent a property in London, I did a very specific video which might be of interest for you. The link is down in the description or you can find it up here. Now, this is where the market gets really interesting nowadays, because affordability pressures are finally starting to affect behavior. According to the Long Rest Agent survey, 61% of agents still expect rents to rise in 2026, but most of them now forecast much more moderate growth of between 1% and 5%, rather than the huge increases we saw after COVID. And the really important data comes when you break demand down by price point. Properties under £1,000 per week are still seeing strong tenant demand, with a positive demand balance of plus 31, but once you move above £5,000 per week, demand weakens sharply, with a negative balance of minus 53. That's extremely important, because it tells us that the market is becoming much more selective. Tenants are still active, but they are becoming much more conscious of value. And from an asset management perspective, this changes everything, because during boom periods almost any property rents. But in more balanced markets, quality starts to matter much more. Presentation matters, management matters, amenities matters, pricing strategy matters, and the overall tenant experience matters. And we are actually experiencing this directly ourselves from a property management perspective. Compared to 2025, demand overall still feels relatively strong, but the difference today is that tenants are becoming much more selective. A good flat with a good layout, strong natural light, good condition and a proper standard of management can still rent very well. And in many cases, tenants are still happy to pay a premium for quality. However, average properties or poorly presented properties are taking longer, generating less competition and becoming much more price sensitive. So the market is not simply saying rents are going up or rents are going down. It is becoming much more segmented. Good stock still performs, weak stock gets exposed, and this is where professional landlords and professional property managers usually outperform non-professional landlords. And finally, we need to talk about regulation, because the Renters' Rights Act is now becoming one of the biggest operational changes the sector has seen in years. Many agents believe the legislation is already pushing smaller landlords to leave the market or sell assets entirely. Some landlords are uncomfortable with open-ended tenancy structures. Others are worried about compliance, cost and reduced flexibility. Ironically, this could make the market even more competitive for tenants in the long term, simply because fewer landlords means less supply. And again, this is where professional asset management becomes critical, because the market is no longer rewarding passive ownership. Today, performance increasingly depends on operational quality, compliance, tenant retention, realistic pricing and long-term strategy. Owning property in London or anywhere else in the UK is no longer enough on its own. Increasingly, success depends on how well that property is managed, positioned and operated. So overall, London's rental market in 2026 is clearly entering a different phase. It is not a collapsing market, it is not a booming market, but is now a more balanced, more mature and increasingly professional one. Rents remain historically high, supply remains constrained. Prime London still attracts global wealth. However, success today depends, as we have seen before, much more on how assets are managed rather than simply owning the properties. And that may be the biggest transformation happening in London real estate right now. We are now at the end of this video. If you enjoy straightforward, practical conversation about property, you are in the right place. This channel is all about real estate, whether it's investment, development, asset management or market updates. No hype, no shortcuts, just practical insight into how property really works. If this interests you, be sure to subscribe and turn on notifications so you never miss future updates. Thanks for watching and I look forward to seeing you in the next video. Ciao!